Disney panics as failing theme parks collapse. Coming from the New York Times, Disney's parks struggle exposing a new trouble spot. Company-wide profit increased, the result of hit movies and streaming growth. But Disney said softening theme park demand could impact the next few quarters. That implies over the next year or so, and somehow they weren't anticipating this. Disney is an amazing, enormous company, but it really feels incredibly badly managed. Going back to 1957, there was a synergy chart that was sketched out showing how each part of Disney's business feeds into the rest of Disney's businesses. This is why the core Disney brand was so important to maintain, to enrich, and make sure that nobody could possibly love a character more than you could love Mickey Mouse or Donald Duck or any of their characters or any of their properties, any of their theme parks. Any of their businesses were done in such a way that were really, really special, which was very important to Walt Disney personally, but it was absolutely crucial to the business. If the theme parks aren't doing well, if the theme parks are not doing the business that they expected them to do, sure, the economy is part of that, but a much bigger part of that is that the theme parks have lost their magic because Disney has long since lost their focus. You can only rely on people's memories for just so long. Coming from CNBC, in a reversal, Disney's media assets are starting to generate more excitement than its theme parks. For the last few years, Disney has been relying on its theme park business to generate the cash that it needed to make investments in media, to make investments in its streaming services. Right now, they're declaring that if you look at all their streaming services together, according to their accounting principles, which is my way of saying I don't completely believe it, because they can make certain costs arbitrary. Revenues are revenues. Even revenues can be made arbitrary, can be made as projections and then plugged into different numbers. Suffice it to say, even the profit they claim that they made from their streaming businesses, it's not going to replace the money that's not going to come in from the theme parks. From the WallStreetJournal.com, Disney's blockbusters can't smooth parks' rough ride. Weakening consumer spending is hurting the Mouse House in its most profitable business. It's also because the parks aren't what they used to be. This was from earlier today, from Fox Business. Classic Disney ride malfunctions, sending guests slamming into doors. Disneyland's Alice in Wonderland ride malfunction caught on camera. The maintenance is not the same as it was, and I understand you want to cut costs. But if the parks aren't going to be safe, if they're not going to be clean, they're not going to make the same kind of profit they would normally make. And the parks are not a cheap business to run. When you're running a business, it's very important to look at what your costs are and, of course, your prices. If you're new in business, don't price your services too low. That's something we all do when we start a new business. Look at what the market's willing to pay and deliver exceptional value for whatever you charge. Disney doesn't have that problem. They charge a lot for everything. They've monetized every aspect of their theme parks. Everything you want to do in a theme park costs money, and it's not just the ticket. And even with all that price raising, some would say price gouging, all of those revenues need to always cover all your costs so you can have a profit. Keep in mind as well, not everybody goes to a Disney park every year. So if you haven't been to a Disney park in 3 years and now you're going to go to a new Disney park, you will find out that things cost more and they charge for more things than they were charging for 3 years ago, 4 years ago, 5 years ago, and in some cases, 1 year ago. That's a group of customers that are going through their vacationing cycle and their consumption cycle that will at some point say, okay, now you've gone through the 5, 6, 8 year cycle, whatever it might be, where everyone who might go to one of these theme parks actually does go to a theme park. They have an experience where the parks aren't clean, the rides aren't all working properly, they're not all safe. They're having brawls in Disney parks. The company also lost their magic when they decided to focus on ideology and trying to push an agenda instead of just pleasing their customers. As people go through all of that experience and they run through the entire sales cycle of all the people that would go to a theme park, the parks business does not look like it has a good future. Even a year or two ago, it actually did have a good future. It looked like things were working and were going to continue to work. But in a cost-intensive business like their theme parks, which is to say that it costs a lot of money to run these operations and to finance these operations, if their revenues go down just a little bit, it severely damages their profitability. Because even on slow days, slow weeks, slow months, you've still got to pay your expenses to keep up massive theme parks. And they have some tremendous competition from Universal as well. They want to be in this business. They will offer a value to people when they go visit their parks. Disney doesn't have this whole industry to themselves anymore. And as the Wall Street Journal said, they can do well in a couple of their movies. They can return to do what they should have been doing for the last several years, focusing on producing entertainment that people actually want to see, to help over time build their synergistic model again. Get people interested in their characters, in their stories. Subscribing to the streaming service because they want to see Deadpool and Wolverine on the streaming service. Yeah, that's all great. It's going to take years to put back in place, and management needs to really focus on doing this. Are they going to do it? I don't think they're going to do it. I'll tell you what I think is really going to happen. Bob Iger will leave the company in a year or maybe even 2. When he leaves, a new management team will come in. There will be massive consolidation and massive layoffs. They don't manage the company well. They don't coordinate between all of their different divisions. They don't focus on a synergistic business model where one part of a business really helps another part of a business, where they all make sure that the customer comes first, where they make sure that no one can compare a Disney product or any of the products that Disney produces, any of the Pixar, any of the Lucasfilm, any of the Marvel, anything they own and control is supposed to be head and shoulders, hands down, better than everyone else's, which they can afford to do, and they're capable of doing if they focused on it. But this management team isn't like that. They don't focus on the product, and they don't focus on the customer. From CNBC and Reversal, Disney's media assets are starting to generate more excitement than its parks. Here's a surprise. Disney's media business isn't weighing down the company anymore. Now, that's a big statement, and I like Alex Sherman, the journalist, a lot. The media business is not okay at Disney just because they claim they didn't lose money in streaming this quarter, and just because 2 movies they put out actually worked out. Those movies working out was Disney delivering at the minimum level. They still have tremendous issues dealing with all of their linear networks and cable channels. The primary Disney investor narrative since 2022 has been how streaming losses combined with a declining traditional pay TV business and a string of box office failures have been angering surging sales and profits at the company's theme parks and resorts. The result has been a company whose shares have fallen about 24% in the past 2 years, while the S&P 500 has gained 28% in the same period. Unbelievably terrible results because they're not focusing on the business. Disney still has assets, properties, distribution like no other business has. It should be an absolute, gigantic, successful American money machine. But it isn't. The company's second quarter results suggest a shift is happening. Disney's combined streaming businesses, Disney+, Hulu, and ESPN+, turned a quarterly profit for the first time ever, making $47 million. That's a significant improvement from losing $512 million in the same quarter a year ago. Yes, that is an improvement. But what I would have you do is go back and look at the charges, the write-offs that they took, the advanced expenses that they took on content they bought that they decided was now going to be worthless. By doing that, it makes it look like their expenses in the short-term future, like, for example, this quarter, are less than they actually are because they took all of the expense out of certain shows that they produced that they decided didn't work out. So these numbers are not black and white straight up numbers. That's what you take away from that. Disney's theatrical unit is also on a hot streak. Inside Out 2 became the highest grossing animated film of all time in recent weeks. Deadpool and Wolverine has taken in $824 million after 2 weeks of global release. And Disney has become the first studio in 2024 to top $3 billion in worldwide ticket sales. Meanwhile, Disney saw a moderation of consumer demand towards the end of fiscal third quarter that exceeded our previous expectations, they say, for its theme park divisions. And that caused shares to slump about 3% in early trading. 3% of a company that's worth around $160 billion, you could do the math, is almost $5 billion down. Disney CEO Bob Iger said during his company's earnings conference call that he expects the momentum for the media business will only gain steam. That's music to the ears of Wall Street, which wants both growth and profitability. Quote, "We feel very bullish about the future of this business," Iger said, in reference to streaming. you can expect that it's going to grow nicely in fiscal 2025. Iger referenced the planned crackdown on password sharing, which is something Netflix has already long since done, which will begin in earnest in September as a tool that will help generate new subscribers and added revenue for the company. A similar effort from Netflix has helped the world's largest streamer, Netflix, add new customers during the past year. Disney is also raising prices for its streaming services in mid-October. Most plans for Disney+, Hulu, and ESPN Plus will cost $1 or $2 more per month. Iger rattled off a list of movie titles that Disney hasn't yet released to emphasize the studio's solid positioning for the rest of 2024 and beyond. Quote, "Let me just read you the movies that we'll be making and releasing in the next almost 2 years. Iger continued, "We have Moana, Mufasa, Captain America, Snow White, Thunderbolts, Fantastic Four, Zootopia, Avatar, Avengers, Mandalorian, and Toy Story, just to name a few. When you think about not only the potential of those in box office, but the potential of those to drive global streaming value," Bob Iger said, "I think there's a reason to be bullish about where we're headed." Disney isn't de-emphasizing its theme parks. The company said last year it plans to invest $60 billion in its theme parks and cruise lines over the next decade. But it's undoubtedly healthier for the company to persuade investors that the media units aren't weighing down the share price. Disney also notably lost control of the Reedy Creek district it had in Florida, essentially like its own kingdom that it ran. It was really its own government in Florida where it had its theme parks. It was an incredible deal. But they lost it because they played games with the state of Florida and threatened the state of Florida over challenging Florida's laws that protect children. That kind of mismanagement is so ridiculous, is so inexcusable. And while there may not be any excuse for it, it explains why they blew their synergistic map that I showed you earlier, and I'll have a link to it in the description below, that was made in 1957. They've been analyzing for decades upon management team how to produce a great product and get it delivered to people like no one else can do. And primarily under the leadership of Bob Iger, they threw all of that away. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another story. And if I don't see you, I will miss you.